Success in commodities trading requires translating short, dense strings of text into millions of dollars of physical material moving across the open ocean. We can see exactly how this works by analyzing the market update distributed by Polymer Bazaar on August 3, 2026. This visual represents the raw daily feed traders digest every morning. It is a dense cluster of prices, chemical shorthand, and localized acronyms. Isolated figures like $840 or €955 define the current market range, but they require a specific delivery location and legal terms to become actionable for a buyer. By systematically deconstructing this single update, we will map the mechanics that dictate global petrochemical pricing. Take a look at this breakdown of the naphtha line. Every quote in the bulletin is built on three distinct variables: the product, the location, and the Incoterm. Naphtha is the primary upstream feedstock. The majority of the other chemicals on this list are derived directly from it. The data shows a base price of $840 per metric ton. The minus 35 indicates a direct mathematical price drop from the previous trading session. But the $840 price tag is entirely dependent on the final segment of the line, C and F Japan. This phrasing modifies the cost. Every valid price quote in this market is a composite equation. It combines the raw value of the commodity with the shipping logistics and legal conditions required to move it. In international shipping, the acronym C and F stands for cost and freight. This visualization shows the mechanics of a C and F transaction. The $840 quote means the seller pays for the raw naphtha plus the freight costs required to transport that material to a destination port in Japan. However, C and F carries a specific stipulation regarding liability. While the seller pays for the transit, the physical risk of the cargo transfers to the buyer the moment the goods are loaded onto the ship at the origin. Because the buyer assumes the insurance costs and transit risk across the ocean, a CNF price is inherently lower than a fully protected landed cost. Moving downstream from naphtha, we reach the propylene and ethylene data blocks. This map tracks the three distinct global pricing hubs used in the bulletin: the U.S. Gulf Coast, Northwest Europe, and the East Asian seaboard. The data reveals an immediate divergence in macro trends. In the United States, propylene and ethylene prices are both trending up. Notice the unit formatting. The U.S. market uniquely quotes these chemicals in cents per pound. Europe and Asia, which quote in dollars or euros per metric ton, show broad, distinct downward price corrections. Global feedstock prices operate within highly localized ecosystems. When regional hubs diverge, traders identify arbitrage opportunities, buying and contracting markets to sell into surging ones. This chart compares two European propylene quotes from the bulletin. By isolating CIF Northwest Europe at €955 and FD Northwest Europe at €1,055, we see an exact €100 difference for the exact same chemical. CIF stands for cost, insurance, and freight. The €955 price only covers getting the cargo to a destination port in Northwest Europe. FD means free delivered. The €1,055 price dictates that the seller brings the cargo all the way inland to the buyer's actual facility. Subtract the port price from the delivered price. Local overland logistics in this region cost exactly €100 per metric ton. Traders extract these hidden final mile transit costs purely by analyzing the delta between different delivery terms within a single regional market. The final section of the bulletin covers intermediate chemicals: styrene, PTA, and MEG. Across these intermediates, a specific Incoterm repeats: FOB Gulf Coast, FOB Rotterdam, and FOB Korea. FOB stands for free on board. Under this term, the buyer assumes all international shipping costs and risks the exact moment the cargo crosses the ship's rail at the port of origin. In physical terms, FOB represents the commodity sitting on a ship at its starting line, waiting for the buyer to route it. Because the buyer handles the ocean transit, an FOB quote is the purest baseline price of the chemical itself, plus local loading fees. It is completely stripped of international freight variables. To compare the true raw production competitiveness of different global regions, FOB is the only accurate metric to use. The August 3rd bulletin now functions as a structured matrix of readable intelligence. Decoding this text revealed a localized U.S. price surge versus a European and Asian contraction, and allowed us to extract hidden €100 overland transit fees. In the petrochemical industry, price discovery means nothing without logistical context. Knowing exactly who pays the freight and who holds the risk forms the foundation of identifying arbitrage and securing profit. Proficiency with a market ticker depends on an understanding of the physical geography and legal responsibilities that connect the global supply chain.